Hey everyone, Longacres Finance here. Welcome to the channel where the mission is to seek out the best high-quality dividend stocks that offer safe, reliable, and growing passive income streams. If that is your goal too, make sure to join the community and subscribe to the channel. Today, I want to share with you something I came across when I was reviewing the performance of past high-yield dividend watchlists. The past watchlists have included anywhere from 19 to 30 unique stocks. I started tracking the watchlist in November of 2020. That means I now have 8 months of historical data, which isn't a lot, but I wanted to go back and see if my ranking system had any correlation with total returns. Basically, I wanted to see if stocks that rank better in my scoring system offered better returns. So what I did was take the top 5 stocks from each month's watchlist and took a look at their returns. I did this for the next 5 stocks as well, so stocks that ranked 6 through 10, and once more for stocks that ranked 11 through 15. And of course, I compared the results to the overall watchlist return. Before we jump into the data, I'd like to mention that the last 8 months have been a better than average period for high-yield dividend stocks. As the stock market switched from growth to value in the recent past, many dividend stocks saw better than average returns. I don't expect such high returns to continue, but I do expect that stocks on my watchlist will continue to offer strong returns when measured against the high-yield dividend index. Let's see how the ranking system performed during the past 8 months. I've got the stocks color-coded so they are easier to identify. A blue highlight is used for the top 5 stocks each month, a green highlight is used for stocks 6 through 10, and a pink highlight for stocks 11 to 15. Here you can see the total return for each stock during a given month, properly coded for where they ranked on the watchlist for a given month. Let's start with November of 2020. The average return for the November watchlist was a smashing 13.29%. Stocks ranked 11 to 15 returned an even better 17.03%. Stocks ranked 6 to 10 returned 18.16%. Just barely ahead of their lower-ranked counterparts, and the top 5 stocks returned 16.16%. So the best stocks performed better than average, but behind the next 10 highest-ranked stocks. Let's jump to December 2020. The watchlist had an average return of 2.78%, a solid month for the watchlist stocks. Stocks ranked 11 to 15 returned 0.51%, coming in grossly under the average. Stocks ranked 6 to 10 returned 4.68%, and the top 5 stocks returned 5.4%. So the top 5 stocks offered the best return in December, and stocks 6 through 10 were close behind. Let me just reveal the rest of the returns, and we can skip right to the overall analysis. So as you can see, for the 8-month period that I have data for, the total return of the watchlist was 35.89%. Stocks 11 to 15 offered a slightly better return of 39.63%. Stocks 6 to 10 smashed the average return, picking up 50.57% in those 8 months. And the top 5 stocks finished just shy of stocks 6 to 10, with a total return of 49.56%. So during this 8-month period, the top 10 stocks offered the highest average return. This shows that there is merit to the ranking system, but the trend must continue for a longer period of time before it can be fully confirmed. The problem with testing a system over a long period of time is that you can't go back in time and invest in something that proved to work in the past. What I'm going to do is start fully utilizing this system starting now. Over the last few months, I would invest in these stocks, but I didn't fully allocate to just the top 10 stocks. Before I share the new investing plan with you, I'd like to explain how the ranking system works. There are 9 inputs that go into the ranking system. The first 3 are qualitative metrics, and they are the moat, the stewardship, and the S&P rating. The remaining 6 metrics are quantitative. They are the payout ratio, the 5-year dividend growth rate, past 5-year revenue growth, past 5-year earnings growth, the current dividend yield, and the current valuation. Essentially, the better each metric is for each company, the higher the score it receives. So a company with a wide moat will score higher than a company with a narrow moat. The same goes for stewardship and the S&P rating. Companies that have grown their revenue, earnings, and dividends faster get higher scores. Companies with a lower payout ratio get higher scores. Since this is a high-yield watch list, a company that pays a more generous dividend yield today is given a higher score versus a lower-yielding company. And finally, each company is either boosted or penalized for its current valuation. In total, a company can score up to 24 points, plus or minus the current valuation, that is multiplied by 10. So for example, Amgen is currently potentially 9% undervalued. Therefore, it gets a 0.9 point boost for its current valuation. In addition to this ranking system, there is a minimum threshold for each metric for a stock to even make it onto the watch list. That's why some companies drop off each month and new ones appear. Thus far, this rule-based approach to selecting dividend stocks has proved to work nicely. But time will tell if it can offer above-average returns over the coming years. Now on to the new investing plan. I have decided to take my Roth IRA portfolio in M1 Finance and apply the following investing strategy to it. The reason I am doing this with a tax-deferred portfolio versus a taxable portfolio is because in the Roth account, I can sell a position without incurring tax liability. Basically, a Roth IRA is a tax-free investment, so long as you have it open for a minimum of 5 years and don't withdraw the funds before you reach 58 and a half years of age. It's a wonderful product for those who are eligible to invest in it. I would recommend that everyone open a Roth IRA, especially if you are younger. It doesn't take a lot of money to open, and the tax-saving benefits when you retire will be exponential. If you'd like to open a Roth IRA or a taxable account on M1 Finance, you can use my referral link in the description below, and both you and I will receive a $50 bonus from M1. But make sure you know how M1 Finance works, and that it fits your requirements of a brokerage before you decide to open an account. If you have any questions regarding M1, you can reach out to me directly, and I can give you my personal opinion of the brokerage. My email is in the description below as well. Okay, so back to the investing plan. I want to take the top 10 high-yield dividend stocks from each month's watch list and allocate 25% of my Roth IRA account to these 10 stocks each month. Another 55% will be allocated to the top 20 high-growth dividend stocks from that month's watch list. 6% will go to the top 3 monthly dividend stocks I like, which are Realty Income, Stag Industrial, and Main Street Capital. And the final 14% will be split evenly between 2 Vanguard funds. The Vanguard Information Technology ETF, ticker symbol VGT, and Vanguard's Large Cap Growth ETF, ticker symbol VUG. These 2 funds will give the portfolio exposure to some non-dividend paying growth stocks that my strategy doesn't naturally target. Since we are in the middle of July, I'll start tracking how this portfolio is doing starting in August, and I hope to share that experience here with you on my channel. My Roth IRA isn't a large account. I think right now it has around $4,500, and I only add a marginal amount of money to it weekly. Most of my retirement saving goes to my personal 401k account for now, but I hope to increase my Roth contribution in the future. That's it, guys. Let me know if you have any questions, or if you'd like to know more about anything I shared with you today. Thank you for watching. Don't forget to subscribe, and see you next time.